This is Market Pulse by Faster Forward from Northern Trust Asset Servicing, the podcast where experts share their insights on the current trends in the markets and financial landscape. My name is Marc Mallett, Chief Strategy Officer for Asset Servicing at Northern Trust, and I'll be serving as the host for today's episode. With me today is Gerard Walsh. Gerard's the Global Head of Client Solutions for Banking and Markets at Northern Trust. Gerard, welcome. It's great to have you here today. I'm really looking forward to our discussion. I know T+1 is going to be a big change for everybody, and looking forward to hearing what you have to say.
Thanks very much, Marc.
Look, before we kick off and we get into everything about T+1, I think it'd be great for the audience to hear a little bit about your background and your role at Northern Trust.
Sure. So I've spent about 20 years in financial services, and before that I was a consultant, and before that I started my career in the oil industry of all places, back in my home country of New Zealand.
When you were 5?
It feels that way now. So my current role at Northern Trust is as Head of Client Solutions for Banking and Markets, and what that means is that for all of our trading solutions, as they stretch across the front office, global equities trading, global FX trading, bonds, derivatives, our securities lending, securities financing franchise, and into our banking and treasury solutions as we offer those out to managers and asset owners. All of those fall into the remit of my small team of experienced people here at Northern. And we go out and we find managers and owners, and we help them take apart their jigsaw. And where their jigsaw needs parts replaced, we work out whether Northern Trust can play a part in replacing parts of that jigsaw with things that make their life simpler, more efficient, more cost-effective.
Oh, that's great. It sounds like can have a pretty substantial impact on our clients' business and hopefully helping them achieve their objectives.
We can, yeah.
Look, it'd be great if you could just start by describing, what the move, with this move to T+1 settlement, who exactly is impacted?
So the SEC has regulated the industries here in the United States for decades. And what the SEC tends to want to have happen, and it tends to have global impact. So we shouldn't forget that Canada and Mexico are moving to a T+1 settlement cycle at the same time. But for the purposes, let's focus on T+1 as it impacts the US, because US dollar investing is of such enormous scale globally. I saw some numbers this morning from a Wharton paper that only a few years back, $35 trillion or thereabouts of US dollar denominated assets that will be captured by the move to T+1 are owned by foreign-based managers. It's a vast, vast part of the market. Now, the reasons for this change, the reasons for shortening the settlement make really good sense to managers. It's supposed to mitigate the risk of trades being unsettled and ultimately of trades failing, and managers failing to change the beneficial ownership of an individual instrument and therefore being exposed to costs, risks of those failures within the industry. Because for every quite simple looking trade, you click on a button on a mobile phone these days and you can trade a US stock or a US listed ETF. There's a long daisy chain of things that have to happen between a long list of actors in that daisy chain, and each of those has to go well in order to settle the trade. Now, at the moment, that's on a T2 cycle. Most of the rest of the Western world and many, many emerging markets and frontier markets are on T2 or longer. But the US, Canada, Mexico are about to shorten that and therefore introduced some settlement risk between T+1 settlement cycles and longer settlement cycles, and indeed shorter settlement cycles where some markets are already T0. So there's some contention at the front end of the trade as well.
And was there a particular motivation from the regulators from the SEC to push this through? And I feel like it's been talked about for quite some time, and it's sort of like now it's here.
Yeah, so settlement cycles have changed. They've been shortened. The most recent change here in the United States was back in 2017 from T3 to T2. But if you look back towards the 1990s, settlement cycles were out as long as 25, 30 days. So the advent of automation, the advent of computerization means that data can flow more effectively between market participants. This move from 3 to 2 back in 2017 still left the rest of the world with an entire working day in their own time zones, a full working day when the sun's up.
So for all those the $35 trillion of holders outside the U.S.
Yeah, you're sitting in Auckland in New Zealand or Sydney in Australia, or you're sitting in Singapore. You can do a normal working day and live with a US dollar T2 cycle because it's in your normal working pattern on a day where you're just in the office normally. That change back then is one of the reasons why I think the industry's quite relaxed about this change. But the change is really quite dramatic here because that working day in your own time zone doesn't exist when it's T1 here in the States, because things have to happen overnight or at unfriendly times if you're sitting in those faraway locations, well, certainly far away from New York and Chicago. And at times when it might actually be your weekend, it might be a Saturday night, it might be a Saturday morning where you're expected to go in and do the bits of bolting together the trades, the trade processing, the matching, clearing, settlement of a trade, and then the trade-related FX at times when you'd rather be sitting at home having Eggs Benedict with the family.
Absolutely. Well, so with that, recognizing that because it doesn't sound like much. Okay, well, it's 2 today. It's going to 1. How big of a deal is it? What are you hearing from the market, like from clients, prospects? Like, what are the pressure points? Where are they? Yeah. Where's the concern?
So managers have spent a long time, in relative terms, because regulation of this scale, generally what we've found over time, if you think back to some of the really big changes, if you think about Sarbanes-Oxley, if you think about Dodd-Frank, if you think about FATCA and their implementation, if you think about MiFID II in Europe almost a decade ago, those took years to go from idea, proposal, consultation to regulatory, as they're called here by the SEC, final rules. This was very, very short, and it was in response to, generally accepted, this is in response to the meme stock bubble of a couple of years back, where trades were failing in a couple of well-known names because the industry simply couldn't cope with the flow in those names, driven by people on various social media applications, investing and disinvesting in a couple of names at a speed that the industry had never seen before. So that's the driver for the settlement cycle change. What we're finding when we talk to managers is managers all over the world, and Northern Trust has spoken to thousands and thousands of managers through a series of webinars, through face-to-face contacts, through attendance at conferences. The list is long of the ways that Northern Trust's made an effort to communicate out to the manager community, to the asset owner community. What we're finding is they've focused a lot on the middle and back office processing, that necessary stuff that has to happen behind the scenes when somebody clicks the smartphone button. And of course, Northern Trust works only with institutional managers. So where somebody's buying 10 of something, we're dealing with people who are buying 10 to the factor of 10 of something and looking to trade those. What we're finding is the middle and back office processing is flashing up green in many places, amber in a lot of places. But now in the last 6 to 8 weeks, we're seeing investment managers and asset owners start to ask their portfolio managers and the people who make investment decisions, are you completely happy and comfortable that you'll be able to cope with T+1 because the implications for portfolio managers are so stark? What I mean by that is managers will need to think very, very carefully about how they use cash, their ability to use cash, sources of cash and cash-like instruments, and indeed there's 6 or 7 portfolio management decisions for specific instruments that are captured that need very careful thought, particularly as you approach the end of the working week, where generally what we're finding is the only people who can be comfortable with that live and work in Manhattan. Anywhere away from Eastern Standard Time, including the west coast of the United States, people need to think very carefully about their decision-making as they approach the end of the working week. So
you think that will actually have an impact on investment decisions, where they might have otherwise made the trade, now because of sort of that middle and back office processing, they may have to rethink that approach?
Yeah, there is. There's some, there's things that managers will need to think about, because generally if you are doing, let's say you're doing a back-to-back trade, and I'll use a real example of a stock that a lot of American investors have been engaged in for the last couple of years, and it's the manufacturer of the wonder drug. So it's Novo Nordisk, which is listed in Denmark, and it's listed in Danish kroner. So managers here might make a decision to sell Novo Nordisk. That's on the Copenhagen stock markets. Copenhagen stock markets are still a T2 settlement cycle. So you make a decision based here in the States to sell that stock. You're not going to get the cash in from that stock for 2 days.
Yep.
Now, if your base currency is dollars, you've got to convert from krona back to dollars. And you might have been intending to do something else with that. You may have been intending to buy Eli Lilly, for example, to invest in their on-cycle wonder drug, whatever it may happen to be. But you may have been doing something even more complicated. You may have been deciding to invest that offshore again. And you may have been deciding to go to, let's say, Australia and buy the Australian miners. Now, doing that late in the week becomes complicated because you won't have the cash back in the States until after the weekend. So therefore, as a portfolio manager, you need to think carefully about your source of the second part of that. And you need to think carefully about your ability to get the trade-related FX done on both legs, the Danish kroner to US dollar, and then US dollar to Australian dollar, and to do those things as the weekend approaches. This is the point about what looks really, really simple and effective and efficient on a screen by pushing a button called trade, is followed up by a whole series of steps that have to happen by a whole series of actors as they move through these things.
So with that, you touched on some of the FX, related challenges, and really what it sounds like, it's cash management.
It really is.
At the end of the day, are there specific types of trades, that managers need to try to? Well, I was about to say avoid, but maybe just to be aware of, so that they're.
Yeah, and it's not. I don't think anybody in a portfolio management seat should sit there and think I am going to avoid trading. You've got to make investment management decisions that suit the profile of the investors that you're working for and the profile of the fund or the portfolio that you're running. But what T+1 will introduce for the whole time that the United States particularly is out of settlement cycle with some of the world's major markets is the need to think very, very carefully about the direction of the things that you are doing and the instruments that you are using. And it's worth recapping the 6 big things that are in scope for this. So it's all US equities, moving to T+1. ADRs, American Depository Receipts, so the traditional means for the last decade and a half of managers investing into places like China was ADRs. They move in scope of T+1. ETFs, there's more than 3,500 ETFs listed on the US exchanges. They move to T+1. Now the complication there is the underlying components of many of those might stay on much longer settlement cycles. So you see that same selling to buy problem and cash flow movement, but it introduces a pressure point to market participants who've previously been pretty happy operators in there, and that's the ETF sponsors, which I can explain in just a second. So ETFs move inside. So at the moment, T-bills are T+1. So the world, the hundreds of trillions of dollars of trading in T-bills are already inside the T1 window. Now, things that are moving inside are US corporate bonds, municipal bonds, unit investment trusts in the States. And then there's a list that makes up a whole A4 page, or a letter-sized page as it would be here in the States.
And for our listeners that might not be aware, that's larger than letter.
That is larger than letter. There's a list of instruments that fall into scope that managers need to know and understand what is going to happen with these as they look to trade them, as they move to shorten the settlement cycle. There's another complication on the weekend itself and the week after, which we'll cover off in just a second, I'm sure, which is to do with major market structure changes that happen and public holidays.
Yeah. Well, so I suppose we've talked about a number of the challenges, concerns. What can or what are managers and asset owners doing to address these? Is there anything now? I mean, it's pretty late in the game, but that our clients and prospective clients can be doing to prepare.
So managers should not be worried that it's too close. It's not too close to the end of the game. It's not, and May 27th for Canada and Mexico, May 28th for the United States. It's not the end of the game. If anything, it's the beginning.
Yeah.
It's the beginning of the end of the first quarter. So managers should be looking for solutions that help do as much removal of manual processing in the trading, trade-related processing and trade-related FX as they possibly can, and should continue to look for that after T1 happens as well. So they should be looking to, at the moment, move away from the thing that they're so comfortable with because of that extra day, that extra day in your own in your normal working day wherever you are in the world, where you can do the trade-related processing, and the trade-related FX as three discrete and separate activities. What we've been encouraging people to do for the last 9 months or so is to look at that as a single life cycle, and to come to solutions providers like Northern Trust about ways to automate as much as possible in that single life cycle, so you can get those three things done with as few human touches. Clearly, the fewer humans who touch things, the less likely there are to be mistakes, but also to do so on the basis that you're working with a single solutions provider means you don't have to ring multiple providers to find out what's going on or where the pain points are or what's failed in a trade situation. As I say, and I'd reiterate this, even after go live, when the whole industry is expecting failure rates to climb, that the DTCC and the SEC have specific targets around the rates of failure they would like to see, and they're much higher than the current rates of processing. Even after go live, 3 months, 6 months, 9 months from now will not be too late to address this problem with solutions providers like us.
And so you mentioned the 29th, and you described it as it's more the first quarter than the end of the game. I suppose what comes next? Like immediately after the deadline hits. How do you see those those days, and then what happens after?
That's a really good question, and it's a really good question for two reasons. So on the Friday before the T1 goes live, there's a large Russell index rebalance.
Of course there is.
Of course there is. There always is on a Friday. So these are idiosyncrasies that managers need to think about. Lots and lots of managers not like to capture alpha on a Friday. They like to trade on a Friday. There's lots and lots of rebalances that happen on a Friday for many of the major indices. Lots of month ends happen to fall on a Friday. Lots of public holidays are on a Friday. In the States, lots of public holidays are on a Monday, which complicates what you do on a Thursday and a Friday, depending on where you are in the world. So, but let's just talk about the 6 or 7 days around go live day. So there's a major Russell index. That's big. That's big for lots and lots of investors globally on the Friday before. So settlements, trading, all those sorts of things, dollar to other currency pairs will be in flight over that weekend. The Monday, Canada and Mexico go live. It's Memorial Day here in the States. So it's a public holiday here in the States, followed by the second largest market in the world by traded volume, London, being on holiday the following day, both on the 27th.
This was all very well planned.
It was very, very well planned. And then on the 28th, the US, the day after Canada and Mexico, goes live with T+1. So there won't be anybody in offices in the two largest financial centres, or there will be skeleton staff, unless people are called into the offices and told they have to work those 2 days to do anything, and the markets will be closed on the days before. And then, so that's Tuesday the 28th when it goes live. So the industry will have only had Tuesday, Wednesday, Thursday, and then there's the largest MSCI rebalance of the year on the Friday. And in the past, that has seen volumes raised by 200% of US dollar trading versus up.
And just, so our audience understands, like the what makes those events so impactful.
Yeah.
So whether it's Russell or MSCI, when we think about all of, so many ETFs, passive funds that are out there rely on those as their benchmarks, right? So when you think, well, it's just one or two, benchmarks or, or indices. Right now it's hundreds of ETFs
Yeah, it is. It's hundreds of funds that are index trackers. It's hundreds and hundreds of ETFs that are index trackers in that sense. And the complication is that the rebalance forces people in and out of different individual constituent components of those, and therefore they are forced to trade in and out of various things with the associated currency pairs. So it will impact hundreds of fund managers and hundreds of portfolios and hundreds of investment mandates globally in that first week. It genuinely, it's like being stuck in a supersonic plane straight out of pilot school kind of thing.
Sounds like fun.
It sounds like a real challenge.
Yes. Yeah. I think I'm going to find a way to not be around that weekend. We've talked about the U.S. We've talked, it's moving from T2 to T1. You've talked about some other markets that today could be T3, or more. Are there plans for other markets to transition to T1?
So the move in the United States has accelerated the numbers of conversations that market regulators, that governments and market regulators and other industry bodies and other markets are having about their own cycles. So we've seen some interesting activity in places, a good example being Qatar, which is a US dollar denominated market because of its commodity-based GDP. It makes an enormous amount of money on a global basis from natural gas, which is traded in dollars. Their stock market, they announced in March, they were going at the end of March, so an instant decision from T3 to T2. Now, clearly that's driven by the fact that they couldn't be 2 whole days out of sync with where their investments are placed, which is US dollar denominated instruments, whether that be bonds or direct holdings into US dollar instruments. Elsewhere, some of the world's largest markets face much more difficult timelines in terms of their ability to change towards that. The UK has set up an accelerated settlement task force, and they've come out and said, given all of the other regulatory change that's going on, the earliest we might be able to get there is 2027. So there'd be a mismatch between the largest and the second largest markets in the world of potentially 3 years for managers to cope with. This doesn't go away very quickly. The Australians who we thought as an industry might be able to just make a snap decision. A lot of money flows in and out of Australia from their giant superannuation fund industry towards the US, and in dollars converted into Australian dollars into their Australian miners, which are in almost every portfolio you can think of: value, mining, energy, all those sorts of things. We thought they might try and move more quickly than it appears that they can, because they've got their own regulatory timelines to work with down there in Australia. They don't think they can get to it towards the back end of the decade. So they're thinking 28, 29 before they can get to these shortened settlement cycles. And then if spoken to people at the exchanges in places like Hong Kong, they're taking a watching brief, but they might be able to move more quickly. But you're still talking some form of notification to the marketplace in a consultation process. That's generally a period of months, and then a notification where you've got to allow people to do the preparation for it. So even if you made a decision at the end of 2024, you're probably looking at mid-2026 before you're implementing. If you made a decision in somewhere like Tokyo, Hong Kong, Singapore, Australia, as we said, was likely to be later. Those matter. And then there's Europe. Now, Europe's a special case. Europe has 18 exchanges to think about. It's got multiple currencies. It's not just the euro, it's krona. There's a couple of time zones. The further east you go towards places like Finland. And there is the political footballs that get kicked around in the European context every time they think about regulation across the continent. Now, that would imply, on the same timeline as they managed to bring in the MiFID regulations, MiFID 1 and MiFID 2, you're looking at very, very near the end of the decade before they're able to make that change. Now, that's a long period of time for managers investing in and out of euro-denominated, or as we mentioned before, krona-denominated investment decisions, in and out of US dollar investments, to be out of sync with each other on a settlement cycle. It's a long time to have to plan for cash, long time to have to plan for operational support, long time to have conversations with liquidity providers or develop some form of cash-like instrument like a future or a derivative program to cover for these things.
Well, we've talked about what we expect to happen, sort of in the immediate aftermath. Like, what do you think the next 6 to 12 months will look like, given the shortened cycle in the U.S.?
So it's a good question, and I was asked this only last week, but isn't this a little bit like for those of us with similar coloured hair, Marc, like the Y2K?
Hey, we still have it. It's okay.
And increasingly, there's not as much of it as there was. Isn't this a little bit like the Y2K bug? back in the year 2000. So there's two things that I'd say there. Yes, it is. It is really quite similar to the Y2K bug, and that's because of the $35 trillion thing. It's big. It's a really, really big global thing. The second reason why it's a little similar to the Y2K bug is the reason, and people have forgotten this, the reason that night back in December 31st, 1999 went so smoothly is hundreds of millions of hours of preparation. And at the time, absolutely vast amounts of money was spent making sure it went smoothly. And a very long timeline to have done so. 6 or 7 years out, technology companies, as you'll well remember, were talking to people about the need to raise projects for this.
For sure.
This only became a final rule 18 months ago. That timeline is very compressed. So it's not like the Y2K bug from the perspective of the industry having had the time to prepare for it. So the impact in the months afterwards may well be a little more turbulent and chaotic. Certainly a little more turbulent and chaotic than it was on that night in New Year's Eve back in 1999.
So, Gerard, if you were a manager anywhere outside the United States, what would you be worried about?
The things I would be checking if I was a manager is I would be checking that I've got the ability to do the trade-related FX as we approach the end of the week. And let me explain why that is. There's both an FX market perspective to this, but there's also a cultural perspective to it too. So no matter where you are in the world, you want to know that you're going to get your trade done. Now, I think even in that first week, even with the things that we've described that are going to happen, people all around the world will get their dollar trading done. It'll happen. They'll get their trading in the in-scope instruments that have moved to T1. The trade will happen because nothing's happening with the exchanges. They will still be open till 4 o'clock New York time. You'll get your trade done. On a Friday afternoon, there's an idiosyncratic thing that happens with FX liquidity, US dollar liquidity, versus every other currency pair in the world, which is that it declines in a sharp line as it dries up to what's known as the witching hour, in between the US market at 4 p.m. on a Friday closing and 5 p.m. when the FX market closes. There is almost no US dollar liquidity versus any other pair in the world available to managers to trade against. Now, if I was a manager, that would be the thing that worries me the most. If I am going to be sitting up at night in Auckland or Sydney worrying about something, it's did the trade-related FX for my trade get done? Because I posted that on Friday morning, my time. Yep. I know that New York was still awake when I did that, but did the trade get done in time? Because when they woke up on the Friday morning, was my trade-related FX booked? Now, there may well be solutions to that emerge, but this is the thing that managers will need to be acutely aware of, is the hidden cost surprises of T+1 could be unwelcome. You could see overdraft rates climb. The overdrafts charged by people to whom managers go for overdrafts could climb. That would worry me if I was a manager. The use of instruments that are currently pretty cheap, like futures forward swaps to cover a long weekend, where there's a bank holiday and a public holiday in the States, they may climb because demand for those may climb between 4 o'clock and 5 o'clock on a Friday in the lead up to a bank holiday weekend. Those would be the things that would have me staring at the ceiling if I was a portfolio manager in a location that's not pretty much smack bang Manhattan, anywhere else in the world.
Well, I think that's great advice to our audience who would be thinking about these challenges as it comes up. It's certainly very timely. So, Gerard, thank you very much for your insights today. It's very helpful for our audience to now to be well educated on where things stand with T+1 and what they can expect over the coming months. So, thank you, Gerard. Really appreciate your insights and your time. And a big thank you to our listeners for joining us on Market Pulse by Faster Forward from Northern Trust Asset Servicing.